Hello, everyone. Welcome to today's webinar. A very good evening to all of our audience that spend their time to attend this very meaningful webinar. Today, we will be exploring contract for difference, identifying opportunities in US market. So to our audience here who are very interested to trade the US market, so stay tuned for the whole webinar and we will share you the opportunities that can be found in the US market. So today we are very honored to have Mr. Billy To, our regional head of retail research from CGSI Singapore, and also Mr. Chua Wei Ren, our market strategist from CGSI Singapore as well. Okay, both of them are expert in the industry where they will share to you the opportunities in the US market. So without further ado, let's start our webinar with an introduction uh, on the CFD product. So I'm Trent. I'll be your host for today. Okay, so introduction to CFD. Okay, today's sorry, whatever presented in this webinar will be mainly for education purpose only. So make sure you make an informed decision before you invest into any investment product. Okay, so for today, we'll be sharing what is CFD, what are the types of CFD, and also the mechanics of trading CFD. And lastly, our promotion on the CFD campaign for this year. So I hope all of you will stay tuned till the end of the webinar. Okay, so what is CFD? So CFD actually stands for Contract for Difference. So it basically allow investor to have exposure in the underlying asset. Okay, and it's a contract that made between the buyer and seller. And the different and how can investor make money? They make through the differences in settlement, which is settled through cash payment. Okay, so CFD can be in many types of form. So the types of CFD that we offer is share CFD, REIT CFD, and also ETF CFD. Okay, so what are the share CFD that we offer? For example, you're interested, you feel that Apple shares might go up or go down, you can actually gain an exposure in Apple shares. So one of the product they offer is Apple Share CFD. Okay, we can long, we can short for this product. Later, I'll share it to you all what are the benefits of trading CFD compared to normal traditional shares. So for Apple CFD, the underlying asset will be the Apple shares. And another example for REIT CFD, we have something like IGB Real Estate Investment Trust, where the underlying asset is the IGB Real Estate Investment Trust ETF. Sorry, REITs. And we also have Pavilion REITs, which is the underlying asset is the Pavilion REIT. Okay. Other than REITs CFD, we also have ETF CFD. Okay. As you can see on the screen, most of the index CFD and also FTSE China index CFD as well. So if you want the full list of the product, you can go to our website at www.cgsi.com.my/CFD. Okay, so if any of the CFD that are not listed on the not on our product list, okay, we actually can add on, provided it complies with the rules that are set by the Securities Commission. So the stocks must be listed on the main board of Bursa Securities. And the another second rule is the underlying corporation must have an average daily market cap of at least 500 million in the past 3 months. And also in the case of a newly listed company, it has to be listed more than 3 months and have a market cap of not less than 3 billion. Okay. And the underlying corporation must meet the public shareholding spread requirement as of the date of offer. Okay. For the full CFD guideline, you can actually go to SC website, which is the regulation website on contract for difference. Okay, so what type of CFD do we offer? We also offer direct market access. So what it means by direct market access? So basically, wherever traders or investors put a trade through our platform, it will actually directly be sent to the exchange. So wherever you trade, will be based on real-time trading on the exchange. Okay. Whereas another model, which is using the market making model, the broker actually will hedge off the position instead of trading the equivalent position on the exchange. Okay, so that's the difference of a direct market access model versus a market making model. So now I'll share to you what are the benefits of trading CFD. Okay, So CFD allows you to have leverage. What it means by leverage? So basically, to buy a CFD, you only need a small amount of capital to hold a larger position. So our margin requirement ranging from 10% to 100%. Okay, so what it means by 10% margin, meaning to say you need to buy, let's say 1,000 ringgit worth of stocks, 1,000 ringgit worth of CFD, you only need 10% of the margin, which is only 100 ringgit. Yeah. So there's 10 times leverage there. One example of leverage. Okay, then for CFD, we have the flexibility to long and short. So it's bi-directional trading. Okay, so but however, our bi-directional trading is only available on US CFD and also foreign CFD as well. Okay, then there's no expiry date of contract. So you can hold CFD as long as you want. Okay, provided you comply with the margin requirement. There is no expiry like futures. Okay, so let me go to the leverage part. Okay, so this is an example on how leverage works. So for example, you want to buy NVIDIA Corporation 100 units of NVIDIA Corp CFD at 180 USD. So in CFD, you only need 10% margin, which is only 1,800 of the total trade as compared to the traditional share which you need 18,000 ringgit USD. Okay, so only 10%. So it's 10% of margin to hold 10% of margin which is 1,800 to hold 18,000 ringgit, 18,000 USD. Then another example would be like Alibaba Group CFD. Okay, Alibaba CFD, which is let's say you want to buy 100 units at 160 Hong Kong dollar, you need 10%, which is 1,600 to hold position of 16,000 as compared to traditional shares. Okay. So with margins, you only need a small amount of capital to gain a large exposure. Okay. However, leverage as is a double-edged sword where gains and losses are magnified. Okay. And the risk can be much greater, and also, while the return can be great, but the risk also can be much greater. Okay, next is the flexible to long and short, which I mentioned earlier. You can take a bullish or bearish stance on the listed share CFD. Okay. And then there's no expiry on contract. So for example, if you buy one good example of product to compare is the futures. Let's say you buy shares futures. So it will actually expire on the second last business day of the month. But for CFD, there's no expiry. You can hold DBS shares CFD as long as you want. Okay, provided you comply with the margin requirement. Then another benefit of trading CFD is that it's transparent pricing. So as I mentioned earlier, we use a direct market access model. Whatever prices that you see on our platform is actually reflective of the prices on the exchange, the underlying asset price on the exchange. So for example, if you see NVIDIA shares trading on Maybank shares price on the platform is actually the same price on the exchange as well, provided the market data is real time. Okay. Another benefit of CFD trading is you can participate in the corporate action. So what it means by corporate action? So from time to time, shares always give out dividend and they have corporate actions such as bonus issue, share split and reverse split and so on. Okay. So all this exercise, the investor, corporate exercise will adjust the number of shares and also the dividend back to investor. Okay. It will automatically adjusted at your platform. So one example is Apple announced a 0.26 US dollar dividend per share. So CFD trader that's holding example 10,000 units will get 2,600 dividends. Okay, of course it's before withholding tax. Please note that CFD holders actually are not entitled for any voting rights here. Okay, so for CFD, all the settlement currency will be in the respective settlement currency of the exchange. Okay, so all profit and losses will be based on the exchange traded currency. Okay. So then next let's talk about the fees. What are commission of trading CFD? Okay. So for CFD, one of the most important thing is the commission, where the amount commission amount, it will be trade quantity times the trade average price and also the commission rate. Okay. So if you can see the table, let's say you are going to buy an XYZ CFD. with a trade quantity of 1,000. Trade average price is 10 USD, and the commission rate will be 0.2%. Okay. Then we have a minimum commission of $15. If you only buy 1,000 units at $10, the commission amount will be $20. Okay. Let's say you buy a smaller amount, 500 units at $5 traded average price, then your commission amount actually is 15 USD because is less than 15, we will charge the minimum amount. Okay. So beware on this. Then another component of CFD trading is overnight financing. Okay, so a financing fee is actually charged daily on the CFD position that's held overnight. Okay, and overnight financing is charged based on an effective rate and is debited or credited from your account on a daily basis lah. So the formula for our financing rate will be financing rate plus minus the central bank rate. Okay, and how we calculate the number of days in a month will be based on 360 days for USD sector CFD or 365 days for non-USD sector CFD. Okay. For more info on the commission and also their finance rate, you actually can go to our website as well. Okay. This is the example on calculation of the long financing rate and also short financing rate. So basically a long position and a short position. Okay. In the case of long position where the central bank rate and the financial rate, central bank rate more than the financing rate, you will be paying an amount of about 7.63%, 7.63% per annum. Okay. Let's say if you are holding for 1 day and you are buying about 100,000 ringgit worth of CFD, then you will be paying about $21.20 per day. Okay. And in terms of short financing, if the central bank rate is lower than the financing rate, okay, you actually receive interest. Okay, so based on our example here, central bank rate is 3.88%, financing rate is 3.75%. Okay, so if we net off the central bank rate against the finance rate, we have an effective rate of negative 0.13. So basically, we will be paying you this 0.13% of interest. And assuming you are holding a 100K position, 100K USD position, then you'll be receiving 36 cents per day. Okay, how to potentially benefit from CFD? So basically, here's a table. Comparison of uh, for Microsoft CFD. Okay, then on when we sell, we are selling assuming we make a $20 profit. Assuming we make a $20 profit on Microsoft share from 500 to 520. Then we'll have a, a gross. We will have a gross profit of 2,000 for traditional share, and also 2,000 will be slightly different because we will have 5% on the traditional share, which is equivalent to almost 1 to 1, whereas percent, which is about 10 times more than the traditional share. Okay. But then again, leverage is double short, so you can make it will magnify your profit and also will also magnify your losses as well. Okay, so this is a scenario in terms of so this is a table comparison on the loss scenario. Okay, so using the same numbers from previously, this time we make the Microsoft shares drop by $20. You enter a long position at 500 and it drops by $20 to 480. So we can see that the return of initial outlay will be for negative 4.39%, whereas the return for the CFD is negative 44%. Okay. Okay, so what are the risks associated with CFD? So whenever you open before you open a CFD account, you must be aware of the risk. So these are all the risks that as you can on screen, all the risks that are associated with CFD. Okay, make sure you understood the risk before you open a CFD account. Okay, so another way, another think that we can help you to identify whether you are suitable for trading CFD, you might ask yourself some of these questions. So do you have any previous experience trading financial products such as securities and derivatives? Or whether do you understand the differences between investing in shares and trading CFD? And do you understand the concept of leverage, margins, and volatility? Okay. Are you prepared to monitor or manage risk of trading? Or can you afford to lose all of or more than the initial capital that you put in? So these are some of the questions that you need to ask yourself before opening a CFD account. Okay, then how to trade CFD? So basically on our platform, these are some of the features that we offer. Okay. Our types of order on CFD, there's a market order, limit order, stop loss, all the basic require market order type that you need is all available on a platform. Okay, this is a screenshot of a platform. Okay, IRES is available on desktop and mobile. Okay, for more info, you can on trading CFD, actually can visit our website. We have all the FAQs there, videos on teaching you on how to start CFD, CFD investing 101 and so on. Okay. So for our CFD campaign, we have a CFD campaign from 1st April to 31st December. So there's about 1 more month, okay, where top traders can win NVIDIA shares and Corti shares. Okay, so thank you. Thank you for listening to my presentation. So now I'll pass on to Billy to share on the US market outlook.
Hi, thanks, Trent. Trent, you can hear me, right? Let me
Yeah, I can hear you clearly.
try my shared screen first. Can you see the screen?
Yes, I can see your screen.
Okay, all right. So good evening, everyone. I'm Billy To, the Regional Head of Retail Research at CGS International. So tonight I'll walk you through some of the key top-down macro drivers that is shaping the US market, right? Including how investors are reacting to the current economic setup and what this means as we head into 2026. I think we also dive into one of the biggest structural themes today, which is artificial intelligence. I'll unpack some of where we are in the cycle, how demand is evolving, and where meaningful opportunities still exist across the value chain. Finally, we also look at the financial sector, a space that could surprise on the upside as the regulation gains traction and a lower rate environment starts to take hold. After that, my colleague Choi Yuan, who is our market strategist, will take you through the technical momentum and show you how to position for emerging trends in the market. So together, hopefully, we'll give you a full macro to momentum view that could help you to navigate opportunities and take advantage of the CFD to make some investment gain for your investment plan. All right. But before I start, let me just clarify that this is actually a quick disclaimer, right? Whatever that is shared is for general information and education purpose. So nothing here should be taken as a financial advice or recommendation to buy or sell any securities. All right. Okay, so let's start with the big picture overview first. I think the first thing we need to look at is the global market performance. And I think, well, a lot of people have been talking about the US market has rallied quite a fair bit. The US exceptionalism story did not happen in 2025, actually. So if you look at the table here, you can actually see that on your right hand side, which is there's the performance change on weekly basis and year to date performance, right? Towards the end is basically the changes in US dollar. So this will actually reflect the currency movement. On the blue color, light blue here is actually the ones in the local currencies. So this will not reflect the currency. So for example, if you look at FBM KLCI, the Malaysian market, right? So this year, the total return as of 28 November is at 1.7%, right? But if you convert it into US dollar, it's actually at 10%. So yes, actually the ringgit has strengthened quite a fair bit, right? But if you compare it to the US market, right? Sorry, let me just go back. If you compare it to the US market, the actually performance actually lagged behind, right? It delivered a return of about 14 to 22% total return. But despite that, actually lagged behind your global equities for most of it. So if you compare the last table, the last row, right, which is the Bloomberg World Index, it actually has a total return of about 21.3%. So it's actually outpaced the US market in general, with the exception of the Nasdaq 100. Right. And if you compare the US against other region, you will see a clearer picture. So if you look at Europe market, for example, the return is about 27 to 35%, right? So that has actually outperformed the US market if you after converting into the US dollar. And even in Asia, if you look at pockets of it, you can see markets like Japan, Hong Kong, South Korea, and even Singapore actually outperform the US when viewed in the US dollar terms, right? So despite the strong headline, the reality is this, that the US did not lead the world in 2025, it actually trailed behind it, right? So what this really tells us is that the market that we are in actually is heading into 2026 actually quite constructive and not euphoric. So if you look at this slide here, you can see I actually highlighted three key areas why I say it's a constructive market. First, the Fed rate cut in December is priced in. So the odds of it has actually pushed up to about 80% of a Fed rate cut in December, driven by softer labor and inflation data. And then we have also seen a US dollar softness so far this year. I think it's something that Trump has consistently said that the dollar need to be weakened, need to be at a more moderate level in order to encourage manufacturing in US as well as exports in US. Of course, the ETF flow, which I think we'll highlight a bit more later, that shows that it has consistently been positive, right, despite some of the volatility we saw in November. So this is really not the euphoric or that the headline news are telling us. It's a lot more disciplined optimism that's supported by data. And historically, constructive phases create some of the strongest opportunities, right? So I've not even talked about the valuation, which is probably one of the downside risks to what we are looking at, but we can probably highlight some of those things in the Q&A later. Right, I talk about the Fed expectations. So you can see from this table, this is actually from FactSet, based on some of the latest commentary by the Monetary Policy Committee members. So you can see that here, most of them actually have a cut or hold, right? In fact, the one of the reason why we saw a shift in the expectation from, I think before that, there's only about 30+% odds that the Fed's going to cut rate in December. But after a commentary made by New York Fed President John Williams, I think that odds have actually gone up to over 80%, right? So that there's a lot more expectations that there will be a rate cut next week. And then, of course, the Fed's Week book also indicates a cooling job market and raising the chance of a rate cut, right? And I think it's also important to highlight this, that the Fed will be ending their balance sheet runoff in December 1st. So this is basically part of the reason is because of the rising funding costs. And I think it also signals a shift towards boosting liquidity in the market. So in short, macro winds are really finally turning positive, at least from a liquidity perspective. Now, if you look at the ETF flow, you can see that, look at this chart here, you can see that the flow has remained healthy, right? So this is actually the flow from within the ETF flow, right, over the last 3 months on a weekly basis. So you can see that despite the sharp drop that we saw in the latest week, right, it still remained positive inflow. And if you look at it, the decline was mainly due to a normalization after a surge in the prior week to about 90 plus billion, right? 99 billion. So you can see that there's a jump on it. And the dotted line is actually the average, which is about 40 billion. So there's about 40 billion of money from ETF going into the equity market on a weekly basis, right? Over the last 5 years, there's about close to 4.5 trillion. Actually, I think it's more than 4.5 trillion now. So it's around that level. And the last 11 months, we've seen more than 1.2 trillion of money actually went into the equity market from ETF alone. What this means is that because ETF flow is usually for longer term investors who do not react so much to the news, is that investors are staying invested. They're looking at it on a more structural growth on a more structural level. And flows like this do not happen in a market that are fearful. They happen when there's a conviction that is building. So what we saw moderation in the inflow last week, it actually really reflect the normalization after a surge in the prior week. Now, zooming into the daily ETF flow, we will see a similar and a clearer picture, right? So you can look at the latest numbers. You can see that the daily ETF flows were actually consistently positive. Most days were actually higher than the 1 month daily average flow, right? And in fact, the last 3 days, out of the last 3 days, 2 of it actually were higher than their average numbers as well. So this tells us that investors were quietly accumulating the market despite some of the ups and downs that we are seeing. So there's not a panic that we are seeing. Now, this slide here, meanwhile, tells us that one of the reasons why we are confident of the US market, if you look at here, the US continue to attract the largest share of global ETF flow, about 55.5%, right, is actually going into the US market. So you're seeing that despite some of the uncertainties or concerns on the headlines, the US continue to remain the most compelling risk reward profile, at least for long-term investors. So what this really tells us is that so soft data is finally becoming a good news, right? We are seeing inflation cooling, but there's no recession. The labor market is softening without contraction. Treasury yields are easing, making funding cheaper across the board. And that the US dollar that drift lower actually helps to improve overall global liquidity. So this is really the perfect cocktail for stabilizing growth and supportive for the equity market. And if you look at the chart there, right, you can actually see that the US money market fund has actually surpassed the $8 trillion level, right? And what's more important is that it's actually double of what it was about 4 to 5 years ago, showing that there's a plenty of money that can be deployed into the market, especially if the Fed were to cut rate, right? So there's quite a lot of constructive, especially on a flow perspective. Now, in terms of some of these macro and sector overview, I'm just going to go through an overview of the strategy before I deep dive a bit into some of the sectors. So you can see from here, right, there's a strong backdrop that's constructive. Like I said, it's not euphoric. And if you look at AI and semiconductors, they are driving a multi-year capex cycle. So that will be the engine of these new market cycles that we're looking into. Tech platforms and clouds are part of that ecosystem. And then, of course, financials are also entering a regulatory and liquidity sweet spot. So in short, it's an environment that really support and encourage risk-taking activities across sectors. So I do think that there is quite a lot of opportunities, especially if you listen to the second part of our webinar later when Varian touch on some of the momentum that we are seeing. Now let's look at some of the sector. Let's talk about the most popular one first, the AI and the semiconductors, which is the engine of this new market cycle. So let's just look at some of the data that we have, right? So the chart on your left-hand side, if you look at this, is basically the data center server components. If you look at the blue color, right, the ones with the largest is actually the accelerator. So you can see that AI accelerator market is projected to exceed 452 billion by 2028, right? So there's a lot more bottleneck in terms of power and compute capacity, not so much on customers. So there is demand for that. And then if you look at the data center capex, is actually expected to grow at over 20% annually until 2029. So this is the kind of sustained investment cycle that can support a multi-year upside for semiconductor infrastructure and networking. So I'm just going to share some of the landscape within the industry as well. So if you look at this, is basically the AI compute landscape. At the top of the chain, of course, are the GPU leaders. So we know NVIDIA has done very well so far this year. And then, of course, after NVIDIA, followed by AMD and Intel. So NVIDIA control most of the market share, about more than 80%, right? So NVIDIA really still dominate this is really thanks to the CUDA and its full stack ecosystem. But AMD is really gaining meaningful traction with its large-scale deployment across major AI players. And then more importantly, we are also seeing a strong shift towards ASICs, short for application-specific integrated circuits, right? So they are cheaper, they are more power efficient, and they're designed for very specific workload. All right. The downside to it is that it's not as flexible, right? In terms of computing capacity, it's probably not as good as what NVIDIA's GPU could offer. But we are seeing that rise in a shift towards that because hyperscalers are really looking to diversify away from the reliance on NVIDIA's chips alone, right? So we saw, I think over last week, Alphabet's share price actually jumped when reports surfaced that Meta would be using its Google TPU chips. So we are seeing that competition is really the biggest risk, especially for NVIDIA, especially in the near term, right? So it's very hard for us to gauge who will be the winner, because I guess we have not, there are no signs showing that there's an entire shift towards away from NVIDIA chips, and the in terms of computing capacity, it is still leading, but there is a difference in terms of there's definitely a lot more competition that they are looking into, right? So you can see the hyperscalers are accelerating their push into custom silicon. It's not just Google. You can see Amazon have their Trainium, Meta has their M-tier, and of course Microsoft with their Maya, and Microsoft also invested into OpenAI. So I think if OpenAI were to be listed in the market, I think they will gain about they will have about 12% to 15% ownership in the company. So who is winning here now? So if you look at this slide, you can see that you can see the custom silicon layer as well. I talk about the GPU players, NVIDIA, AMD already. So if you look at the custom silicon layers, includes your Marvell, your Broadcom. So they're actually providing the essential components and interconnect solutions that make this system viable at scale. So for AI to really work, it also need more than just the chip makers, right? So if you look at the downside, which I put the strategic wildcard, is your Intel. So you also need your foundry players. So of course, TSMC will be the main movers at this point of time, but due to geopolitical concern, and of course, Americans shift towards manufacturing in US and using American companies will also benefit Intel, right? The Trump administration actually invested about 10% in the company as well. So this is all some of the upside to the company, right? So aside from that, you also need more than just that. You also need your networking and optics. Why is it important? Because a lot of your AI models require ultra high bandwidth across GPU clusters. So we are seeing a transition from 800 gigabit to 1.6 terabit optical receivers now. So we have winners like Coherent, who's leading in the 1.6 terabit adoption. We also have Lumentum. So these are players that will actually benefit from some of this demand that is rising in the near term. Now, we also talk a bit on the tech platforms and cloud, which is basically focusing on the monetizing portion. I think the key concern, especially when talking about AI valuation, is how fast will these AI solutions or services be adopted, right? And can they really monetize AI at scale? So if you look at this slide here, you can see the cloud monetization of AI. I personally think that the real money in AI in the longer term is not just in chips, it is in the cloud space. Chips is really just the starting point, right? As GPU supply improves, your cloud spending will reaccelerate. So AI workloads will increase compute consumption and platforms lock in. So your Microsoft, your Google, your Amazon will be able to monetize AI across multiple layers going forward in terms of infra, in terms of the models, in the APIs, workflows, and enterprise use cases. So billing will happen on consumption, meaning there will be recurring revenue. So this is probably be on a longer term basis that we're looking at, which I will touch on later on in terms of where the investment wave is going to come, right? But let's just look a bit on the large language model role within the cloud monetization space, right? So the LLM actually play a very important role, which is why we're seeing the big tech investing heavily into them, right? So part of it is because the whole idea is that, this will help to drive massive compute consumption, because your trading cycle will require a lot of GPU to do that, which is where we are at this point of time, right? I think we are moving into the next phase, which is inference, where that will help to generate recurring cloud revenue. I guess one of the best way to look at I guess we would say proxy with looking into Microsoft adoption rate in terms of the Copilot as well as their cloud business, which is growing at a strong double-digit number, right? So inference is allowing these companies to really generate recurring revenue because it's built on consumption. Then, of course, the LLM will allow enterprises to be locked into these platforms. So, for example, Microsoft Azure is actually using OpenAI ChatGPT, meaning so it's hard for people to leave Microsoft once they're using the cloud space. Similarly, if you look at Amazon AWS, it actually partnered with Anthropic, so it has also caused people to stuck to the model. So, which is why we see a lot of Azure and Google is also starting to collaborate with all these different AI languages, right? So because they wanted to break that system, that ecosystem lock-in that some of the competition are using. Then of course it's also helped them to differentiate the platform. So it allows them to have a certain strategic advantage. So for example, I think Alphabet recently announced their Gemini latest update, and there's a strong positive review on it. So this has actually helped to drive some of the upside in the share price in terms of the news flow. So these are some of the AI platform gatekeepers. I'm just going to skip through this. Now, so the full AI stack, I'm going to just share in terms of some of the layer AI stacks that you can see on going forward, right? So if you look at this slide here, you can see that it's actually more than just the GPU. And if you're only investing in that area, you're actually missing out most of the value in the AI supply chain, which especially in the longer term basis. So you can see that the downside, which the three layer, which is right at the bottom, right? Your fab and manufacturing, your network and optics, and your compute silicon. These are the three ones that are going to benefit first, because from the build out phase, right? When there's a lot more investment into this area, these three players will actually benefit from that, right? But going forward, you see the cloud platform like Azure, your AWS, and your Google Cloud. Then not only that, your AI software framework. So this is linked back to NVIDIA. So part of the reason why NVIDIA chip is so strong in demand is because of its CUDA ecosystem. So once you're using it, it's a bit hard for you to change. To put it simply, is that if you're using Apple, sometimes it's very hard for you to switch into Android, right? So that's something like that, right? Along that line. Then aside from that, you also have your foundation models, which is your OpenAI GPT, your Gemini, your Cloud, your Llama, and the rest. Then it also goes to the app developers. So your not only your Microsoft Copilot, you also have your Adobe. So a lot of these players are actually moving into applications that can be used, adopted by enterprises as well as consumer. So we have not even talked about sovereign AI at this point, right? It's not part of this because sovereign AI is an entirely different thing. That's basically investment by countries into AI in order to protect their own national interests. So that part will also help to support some of the investment in the long term in the AI space. So this is really basically a multi-year investment opportunities and trajectory that we are looking into, right? So like I said earlier, there is certain wave that, and I think this is the best and simplest way to put it, right? It might not be the best way for some of you to see, but it's actually the easiest that I could think of. So the first wave that we are looking at is really the GPU compute build-up phase, which is where your NVIDIA, your AMD will benefit from it. These two are the main players at this point of time. Actually, NVIDIA control most of it at this point. Then, of course, now we are seeing that the hyperscalers are actually diversifying away from the reliance on the GPU. So they're actually going to ASIC and custom silicon. So you have your Marvell, your Broadcom, your Google TPU, all of these are actually benefiting from it. Then most of the hyperscalers, so for example, Google, Amazon, and Microsoft, they're actually developing a lot of this for their own use case, right? So of course, I think the announcement that Meta is using Google shows that they could also be they'll also penetrate into this business area. The third wave, which we also have seen, I think Wei could share some of it later. The optics and networking players, as well as the fab, has actually benefited from it. So you can see some of these names have actually seen increase in terms of their share prices as well. Then, of course, cloud monetization. Once that begin, you can see the stack includes your cloud platforms, your software framework. So, like your Microsoft, your Amazon, your Alphabet. Then the last wave will probably be when AI applications are able to scale on a large basis. So this will include your applications and your LM model. So I think Adobe is one of those that is already aggressively implementing some of that into their software. Meta is also one of them, although it's a social media player. It's actually utilizing a lot of that into its advertising solutions for some of the customers. Right. So last, we just talked about the financials. I talked about the financial sector at the start of it, and I think the deregulation emphasized by the Trump administration, as well as the push towards a lower interest rate environment, will benefit some of this sector. So the Fed easing expectation will support liquidity and drive credit creation. Talk about the deregulation. So this will actually help to accelerate some of the capital relief, right? So you can see lower long end yields will actually help to reduce the unrealized losses on bank securities portfolio as well. Then your market conditions for trading will also improve. So this means your stock market as well as your debt capital market, which is your bond. So both will actually benefit from that. So who will benefit from this cycle in this space? The large global banks like your JP Morgan, your Morgan Stanley, your Goldman Sachs, they will benefit from that. The regional and mid-sized bank will also benefit from that because the lower interest rate actually encourage more borrowing and improve the overall loan demand. So there will be some funding pressure, but it will ease as deposit cost stabilizes. So we do think that the revised leverage rules will also give these banks a lot more operational flexibility under the Trump administration. And last but not least, the investment bankers and market activities. We do think that there will be a lot more activities in the market under the Trump administration. There will be a lot more the big tech, for example, will also tap into the market for some of this financing. I think we've seen that. So and that's one of the concern, especially on terms of for companies with a weaker cash balance position. Right. So I think that's all from me. I will pass the time to Varian.
Thank you, Billy. So I just go through quickly what's the market breadth going on for now, and will the rally can sustain. Okay, so if you look at how the major index around the world, I think last month we did it in October, I think also around this time. But you can see that in November it actually declined, but we still, though it's still declining, like what Billy says about the fund flow to the ETF, I think we are still very healthy. BREF also the same thing. I think BREF yesterday, I think during the last day of it actually dropped. But if you look at the daily BREF, I think the Dow actually most of the stock has already large number of stock has advances. So later I'll show you the chart, the table as well. All right, so healthy breath, and most of the global stocks that we measured still 50 to 60% of constituents are above the 200-day moving average. Though there are some correction, but they are still very very healthy on the upside again. Among them, I think other than North Asia, I think South Korea and Japan shows very strong market breadth. US though it has dropped from 65% drop to 53%, but it's still above the healthy range. So if you factor in the 50-day DMA, I think is over 70%. So short-term breadth, though remain mixed, I think compared to September to now, I mean including October, we are still higher than what we see in September. All right. But relative rallies have been selective by style and sector. All right, so there's a macro backdrop. I think markets are pricing additional Fed easing to year end 2025, and then Japan JGB bonds, the yields has really spiked up. There are some rumors about the the BOJ is likely to hike rate. So once if they hike, then market will likely to go into drawdown because of the yen carry trade, etc. Right, so I think base case, I think we see BREF remain broadly supportive. Some upside and then pullbacks are likely to be viable in region. I think this time round will be a very from now towards the end of 2025 and maybe start of 2026, we can see a lot of range bound choppiness going on for especially in the North Asia and Southeast Asia market. All right, so this is October. All right, so we see S&P 500 sending at 63%. All right, and then I think DAX extends to, I think UK was one of the strongest, but UK has dropped. Hang Seng also at 87.5 and Kospi at 61.2. But I think you can see that the S&P 500 has really dropped to 57.8%. You factor in the Dow and the Nasdaq combination, there will be around 63%. All right, so these are all the factor in as far and goes. So this is what the table, I think this is what we have come up with. All right, so I think Taiwan's still very weak. I think Taiwan's deep further, all right, because it's tech concentrated on this. Topics strong. I think last month was 80%, now it's at 78.7%. Going forward on this. So I think overall the BREF still remain very healthy, and I think India is likely to go back into the 80% range going forward. But yeah. So if you look at the summary, I think long-term participation around 58%, 53 to 58%. And then short-term BREF is more variable, reflecting ongoing leadership concentration. So it's like Billy shows about AI cycle right now. So there are quite a number of counters that can be recycled from the top to bottom, not only on NVIDIA, AMD, Intel, but you can look at there's this ticker called Broadcom. And then you got Microsoft, which is the largest cap in the S&P 500. They are reflecting still potential leadership. All right, so but we look at one thing is the what do you call it? The macro data, all right, and then how the dollar is performing. Dollar is still weakening. We alongside macro, we expect Fed to ease into late October and maybe potentially December. Software labor data has been out, and that I think unemployment rate jumped to 4.4%. This actually give a lot of room for the Federal Reserve to commit to a rate cut in December. So quantitative tightening has been done. So we are likely to see more potential of rate cut, more money, M2 money flowing into the market, and then which cause likely the dollar to fall, to weaken potentially further to 98 for the dollar index. And then you can see that much money is going to flow into the sector itself. I think AI is strong, but slightly overbought, but not amounting to a reversal. But you can look at I think biotech sector. I think this I think one of the one that is carrying up again. All right. Europe I won't go through because this is I think this is one that I won't be touching out. But I think ECB is likely to halt its rate cut policy. So I think because it has achieved its 2% target. So I think Christine Lagarde is not going to do anything. Key thing it will be on Bank of England and Bank of Japan. Okay, so we look at the BREF. Okay, so Japan, I think still strong despite the recent spat between the what do you call it between the Taiwan issue between Japan and China. But I think that the topics and Nikkei still display very strong leadership on this as well. Now I think Hong Kong I briefly touched. I think still very strong. I think but near term wise, very short near term wise, likely to see a very range bound scenario. Because the Hang Seng can't cross above 26,100. And then we are likely to look for further correction down to maybe 25,000, the lower end of 25,000 before going forward. Okay, so this is a global market breadth that we do a comparative view. So on my left hand side is actually the one that I showed you on what do you call it, October itself. This one is the updated one as of today, so you can ignore this November 2025. All right, so you can see that in fact yesterday actually the advanced decline line was for the Dow Jones is actually I think 0.34% of the ratio, 9 divided by 21. So right now I think additional stocks has jumped onto the Dow and then make it to coming into the high movers. All right, so the ratio is back above 1. But however, you see the Nasdaq and the Nasdaq is composite index, so the look at the S&P 500 improving, but there are still much more decline more than advanced. So this means that I think the sector leadership, I think over the longer term, short to long term, I think there are adequate fund flows flowing into the traditional blue chip like your Caterpillar, your builders, and your traditional Nvidia. All these are within the Dow Jones Industrial Average. All right. Okay, so I think let's look at how the market breadth looks on the chart itself. So for the chart, I think this is a weekly chart that we've seen. I think it's still very much strong, though it still haven't commit to a new high. I think we are looking at 49,000, 48,000. But you can see the ADR, the ratio has dipped slightly after recovering from October. All right, but momentum-wise for the RSI has been dropping that bearish divergence, but doesn't mean that it's going for a reversal. But you can see that the momentum has already dipped, but it means that but we do not see any stronger correction right now. Still very much supported above the 50 and 20 weeks EMA. So perhaps any correction down is a good level to buy to accumulate or weakness. Well, the McLean oscillator has been very positive. So slight decline, but you can see that overall from this period in I think in May and June, you can see that there's a broad acceleration. So decline has been weak. So McLean oscillator use a very different methodology, but it's worth looking at. So this one not only measure breadth, but it also talking about how strong it is going forward. All right, S&P 500, same thing, but S&P 500, same thing, is showing bearish divergence, but not amounting to any correction yet. And then you can see that breadth is actually ticking up. Next 100, I think there's some bearish divergence, but is the slope is gentle as compared to the Dow. The Dow is much more steeper. All right, but I think we likely see one more break to the upside. You can see that McLean oscillator, though decline, has been rising up on this. All right, so coming to the last part, I think how FX and global equities outlook was the fund flow. I think Billy has touched on that, so I won't go through much, but I'll talk about how the FX currency is going to affect. So we know that once the Fed commit to a rate cut, I think dollar is softer on the long side. I think if you compare how the dollar performed in the Trump administration in the first term, I think that's between start of 2016 all the way to 2018 when the trade war started, the first trade war started. I think you can see that there's been significant weakening of the US dollars. All right, so I think that's one Trump playbook. I think he favors a weakened dollar on this, and right now I think and as a comment to by Scott Bessent on the weakening of yen, I think Bestnet has prefer yen to not weaken further, but in fact yen to be strengthened. So there's a hope that I think that's going to bring US dollar down while yen strengthen. And maybe another Plaza Accord is going to come, focusing on EU and the rest of the market. Because I think you all remember, I think Plaza Accord happened during the time when um Ronald Reagan was the president, and Donald Trump wished to emulate this kind of outlook, playbook on this. Okay, so 10-year yield slip below 4, but there's a typo, is actually go back to 4% already. So and then the front end has already declined sharply as Fed cut back raises. All right, so weaken moderately, but I think that is likely to heighten towards the end of the year throughout, and then might likely persist throughout Q1 2026. Lower weaker USD, and then will support some corporate earnings going forward on this as well. All right, so I think I shared this before on Dow theory. Improving market sentiment, but the Dow Jones Transportation Index saw some coming back, which is the good news. All right, if this, because transportation recently has been picking up, I think I made a call on FedEx and UPS, and then today I make a call on American Airlines and Boeing as well. So you can see that the transportation based on some of proprietary measurement, we can see that the transportation is picking up, and then is ranked number 2 for the last 1 month. So we are likely to see Dow Jones Transportation to edge up higher, and then the Dow Industrial, if they catch up, means that in the near term, market will be very healthy on this. So yep. Okay, so I think this yield curve spread that we've seen. So once it invert and then it goes up accelerating, then we can see likely the market will be topping out and then followed by a very large correction. But if you can see that, we can see that the slope for this rise has been gentle, means that it's very choppy. So there's no sharp rise for the 2-year, 10-year spread. All right, so we are kind of like safe right now because that we aren't seeing any sharp reversal. Especially in 05 to 07, the period actually is 2006 to be exact. The inversion happened in 05. 06 start to pick up, and then 07 start of the cracks where Beston was going bankrupt in March. All right, so here we do not see any, although it's uninverted, but we do not see any acceleration. Same thing in COVID time. It accelerated after that. All right. Okay, so where Fed fund rate cuts, I think more than 3 times, I would say that there's 1, 2, and then the third time, then given a lag of 3 months later, you're likely to start for a correction down. All right, so right now for this month until the next, we aren't seeing any potential correction right now. All right. So I think due to time issue, I think I'm open for Q&A between me and Billy for any discussion. So yep. Anybody? Yep. Thank you.
Okay, thanks, thanks, Viren, and also Billy for the wonderful presentation on the market outlook and also the technical analysis on various sector and so various market. Okay, so as of now, we have a few questions here. So maybe the first question is, how many more rate cut expected in 2026?
Wait, you want me to take or you want to take? I think currently the market is pricing in around 3.
Okay.
Right, but I think
Mm.
it's too early to look at how many rate cuts. I mean it's good to know. It's a good to know thing. But I guess the market for example, I think the rate cut is more or less priced in for the ones in December. And I think a lot more things that they'll be looking at will probably be, for example, I think in 2026 there will be a new Fed chair. So if Trump get his way, probably someone who's biased towards lowering interest rate, that will be positive for the market. So I think a lot of that will drive the movement in terms of the share price rather than just how many rounds of cuts will be done. So of course the economic slowdown will also be something to monitor because you don't want it to soft to a level that it will trigger a recession, right? We don't think that's the case because so far the Trump administration seems to be focusing on fiscals to drive the economy hot. So we do think that there are some leg to go for the market. Yeah.
Okay. Thanks, Billy, for the wonderful insight. I guess probably have to look at more statistics before we can predict how many more rate cuts in the next year. Okay.
Yeah.
So and then the next question is AI stocks currently on a bubble that might burst?
I think from the presentation, I'm biased towards a level that I don't think that's the case. I think what we are seeing a very different area than what it was in so for example, the .com bubble, a lot of people compare that. So I'll just give an example. A lot of people have been talking about the circular financing or off-balance sheet financing that some of the big tech is embarking. But if you look at their balance sheet as well as their cash flow, a lot of them are actually at a very healthy position. So people say, why is Meta going into off-balance financing if they are so healthy, right? I think the logical answer to that is because a lot of this investment is a very high risk. There are some risk to it. So by embarking into partnership and sort of collaboration in terms of their investment, they're actually reducing the risk. So instead of taking on the entire risk of 100% on their own, they're actually sharing some of this risk with their counterparts. So I think these are some of the ways to go forward too. And I think like what we've heard in the news, which is the case, there are not a lot of players who can actually tap on to do some of this job. So they can't really go far. So it's either Anthropic. So for example, the large language model, the good ones are probably your Gemini, your Anthropic, your your OpenAI ChatGPT. So maybe if you include the Chinese counterparts, you have a bit more players, but they are really only the handful of players. So I just give another example. People say Nvidia is very expensive. It is. So for example, PE trading at about 45 PE forward, right? It is expensive, but their top line growth is over 60+%, right? So there is a risk, and I think that risk will probably be more on the competition front rather than the industry as a whole, because there are some emerging competition that they're looking into, right? That I shared earlier just now. So we do not think that it's a bubble, but yes, we do expect there to be some correction, which is healthy, right? So I think Marian has also highlighted some of the things that we are seeing, right? There's some pullback, but we do not expect there to be a sharp reversal. Yeah.
Okay. Thanks, Billy. Yeah, definitely clear off some of the concern that most of the investors have on the current market condition, which is at all-time high. Okay. So next question. Most application-based counters such as Oracle, CRM, SAP, Adobe have dropped a lot despite their AI integration into their products. So do you think now is a good time to buy, or we should wait a bit longer?
So I think this is a case where if I were you, I would wait, because I think it's a matter of looking at the market, like how fast this adoption will take place, right? So why these players drop is very simple, because they are basically if you look at the stack that I showed you, they're actually at the seventh layer, which is the top layer, which is the applications, right? So it really depends on the consumer and the enterprises adopting it, which we are seeing, right? But a lot of players are really exploring, looking at alternatives to see if it's really doable to replace to use that as to invest it in a long-term basis. So I don't think that there's a definite winner at this point. It's too early to say who will win, right? So I think if I were to play, I would probably look at other players, because there are quite a few options to look into across the entire supply chain. So yeah, the risk is higher because their cash flow is also not as strong, right? So if you look at Oracle, I think it's probably the ones that was highlighted with the higher risk in terms of the capex that they're looking into as compared to their cash flow. So those are things that you have to put into consideration. So I think there are actually better alternatives out there.
Okay, thanks, Billy. Yeah. So I guess investor will have to wait out and see whether the investment are reflective of their cash flow are reflective of their current investment. Okay, so that's about all the questions that we have for tonight. So thanks again, Billy and Weiren, for your wonderful presentation. So I hope all of our audience are able to learn something from this webinar. And thank you, everyone, and have a good night.
Thank you.
Bye bye.
Bye.
All right, thank you. Good night. Bye.